Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to CEO Steve McQuillan and CFO Stephen King of Avingtrans, a leading niche engineer. So welcome, gents.
Hi, Paul.
Well, big congrats on today's excellent results with adjusted EBITDA up 78%, no less, to £12.5 million on turnover of just over £98 million. But before we sort of dig into those details, Steve, I don't suppose you can quickly remind investors of what Avingtrans does, its sort of overarching pie strategy, along with its sort of key USPs?
Sure. Avingtrans is in a sort of one-liner, mini Melrose. A lot of people call us mini Melrose. We're in the engineering space, the same as them. Obviously, we're much smaller, but the kind of positioning is very similar in that we look for assets which are underperforming for whatever reason or undervalued. We improve their performance, and then eventually we exit. So we call it, as you said, buy, pinpoint, invest, exit. And that's been a pretty successful strategy for Avingtrans over the last several years. And indeed, as you know, Paul, we've just recently exited a business called Peter Brotherhood in the last few months, where we made about 4 times gross outcome in terms of what we got for the business versus what we paid for it. So that's basically our mantra. We stick to highly regulated markets. We like those because we understand those supply chains, and there's an opportunity to dominate those supply chains, or at least be a key player in them. And that helps with margins, it helps with positioning, it helps to build the business. And we also look for opportunities to buy and build where possible, but that's not always the case. Peter Brotherhood, for example, wasn't a buy and build. We simply improved it and then sold it again. And we're always on the lookout for new opportunities, and they come periodically. And then we look to see how long it's going to take us to improve the business and then exit again. So that's our basic thrust.
And how do you actually improve these businesses? Let's just say you find a business that can be turned around. Given you've got a sort of like a fantastic track record, what is the secret sauce and the sort of the common theme that you can turn these around? Because I think a lot of people would like to know.
Well, I can tell you some of it. I mean, there's a common sort of playbook, and you find similar sorts of things wrong in the business, and Steve will probably pick up some that I forget. But you know, very often the business is in financial distress. There's some financial things to fix that Steve can touch on and improve the balance sheet. But then commercially, very often the engineering business will get sales teams that haven't been trained on how to sell. Sometimes they haven't even got a sales team, so there's no whether they have any orders, you know. So that sort of thing goes on. And then also internally, in terms of operations, we often find the operations are poorly managed or, you know, poorly invested in. So there's a relatively easy fix there. And then another key thing that we often do is we're just brutal about throwing out loss-making customers or contracts. You know, we're not interested. And we quite often take over businesses where we find they have a portion of their business which is really poor. So we just knock that out right away unless we can increase pricing, which we do on occasion as well. And then that leaves us with a commercially more sound footing for the business. It's interesting that we rarely change management teams. We almost always work with the management team that we get, because we usually find that the previous regime they've been in hasn't allowed them to flourish as much as they could do. Yeah. And that with a bit of help from us, we can help that to do much better. Steve, do you want to pick up on some other themes?
Well, I mean, let's keep a little bit of magic pixie dust in there. But being in financial strength always helps, and people get into difficulties, as we know. But having cash allows you to make some restructuring, sort out leases, sort out supply chains, creditor payments, etc. And it's just a sticky wicket if you do start becoming tight on cash, because the decisions aren't always made for the right reason. You know, getting into LDs, for example, on contracts. But we can keep some of those for another day, Paul.
Yeah, okay. So, Steve, that's a great intro in terms of the better margins, EBITDA margins this year, because I had a consensus of for FY21 for EBITDA of 11.6, and you hit out at 12.5, which is obviously slightly higher. What have you been doing then, Stephen, in terms of sort of like the cost? Is it everything that Steve has just talked about in terms of supply chain and stuff? Or
everything plus, as you say, we've got a good toolbox. We've got great people who we work with, some of them in the business, some of them outside of the business. We always bring Institute for Manufacturing in to look at the bones of the business. But it's nice again to say that we overachieved the results. So we always like to say that. And you know, there's some real major positives, and you know, a tricky old year for a lot of people. I mean, one of the big things is the recent acquisitions, which I guess weren't really that recent, nearly 2 years ago now, but they improved. You know, in that we got better contracts, should I say. Booths especially has got a great order book, as you know, it's at historic high levels, and they're now churning out some really good EBITDA margins, such that you know, we're really pleased. But then you look at the existing divisions, you know, EPM, you know, the markets have been holding up. You know, still a little bit of softness in oil and gas, but holding up. You know, it'd be nice to get the US nuclear supply chain really flowing. But aftermarkets, you know, over 70% again in EPM. The margins are getting towards that magic 15% EBITDA that we always talk about. We like to get them to. Steve mentioned earlier, we took you know, we had to take some swift restructuring in Luton for oil and gas, but you have to make hard decisions, and that's what we always try to do straight away. China's coming back strong, as we know, and you know, a few other bits and pieces. MOD, we're now a top supplier to on the submarine program, you know, and we're going to get some more RFQs hopefully on Dreadnought, which is a turnaround from where Luton was, you know, 2 or 3 years ago, where Steve had to be hauled in front of the Commodore and flogged publicly.
Very much.
But then, you know, PSRE, well, what can you say? Booth, HS2, Stainless Metal Craft, Sellafield, 70 million. Moving to phase 2, that's great news. Ormondy, you know, there's still got some magic still to do there on HVAC. Aftermarket, yeah, okay, it's down if you look on the percentages because we've lost PB, but there is some little nuggets there on Booth and Ormondy, which hopefully we will get some business. Areas that people totally not even interested in, but we like aftermarket, and we always see there's an angle there for most niche engineering players. And then medical, well, what can you say about medical? You know, targeted project management, and I'm sure you'll be asking us questions.
We'll come on to that one later. But before we get there to the sort of the medical high potential opportunity, Steve, can you just remind investors what the sort of key market growth drivers are in terms of sort of, you know, the energy and decarbonisation, nuclear, and all that kind of stuff, just so it gives investors a bit of a flavour of what's driving the top line, because Stephen's driving the bottom line, I can see.
Well, we both drive the bottom line and the top line.
Okay.
So just to remind everybody, we're in the current formation of the business, we're in energy in a broad sense as a market, and we're in medical, which is a small business at the moment, but has great potential, as you say, and we'll come back to that. But in terms of drivers of the energy piece in particular, you know, what we see happening there is both nuclear decommissioning and nuclear life extension in particular being great opportunities for us still. You know, most countries want to get more years out of the existing nuclear fleet, and so that's a great business opportunity for us because there are less people who can service that kind of equipment these days, and so that's really good for us. And of course, as Steve mentioned already, the decommissioning opportunity is enormous, even just in the UK with Sellafield, and we've moved into a phase of you know, more continuous production of boxes now for them, and they need, as we previously discussed, an awful lot more boxes than we currently have contracted. So decommissioning, as I say, and life extension are a key driver. Other energy formats are also good drivers. In particular, what we're interested in is next generation nuclear. So we're doing some good work with people like TerraPower, GE, Hitachi, Rolls-Royce in the UK on their next generation nuclear ideas. So that'll provide future growth, although there's not much of that in the forecast yet because it's a bit further out. And the other thing that's good news in there is starting to see more renewable energy activity going through, particularly in our case, concentrated solar power, where we see some really good opportunities for that kind of technology to be deployed in a big way around certain parts of the world. So those are the key energy ones. In medical, well, it's not showing growth yet because it's the potential of growth, but that's about getting into a new market effectively and creating a new market. But I think we'll probably come back.
Let's go there now, as in terms of the the MRI, the helium-free. Can you just explain what the advantages say of helium-free MRI and also the small form nature of it? What it gives it its USPs and why you enter in that market?
So in most MRI systems, you enter the whole body through a large aperture, and you can put the person entirely down the MRI system. If you shrink the bore down, you can't get a person down it anymore, but you can get an arm down it, or a leg down it, or a baby down it, or a dog or a cat down it. And of course, shrinking the whole size of the system It shrinks the cost of the system. It shrinks the installation cost dramatically, because in particular, when you remove helium from the system, you don't have to have helium ducting in the building that you're in, so you push the helium outside. If there's a helium escape, it's not poisonous, but it causes asphyxiation. So if you can get rid of all that infrastructure cost, you reduce the total system cost remarkably. So all the big systems, although some of them have a reduced helium inventory, they've still all got helium in them. They have to. But if you shrink it down enough, you can then mechanically cool the system instead and get rid of the helium completely. And by the way, it's also a scarce resource. So, not using scarce resources is good news from an environmental point of view also. So that's the premise. But what's the point of shrinking it? Well, the point of shrinking it, therefore, is you start to service markets differently with it. And our two main targets at the moment are orthopedic clinics dotted around the world, particularly in America, and veterinary imaging, because both of them are really quite poorly serviced at the moment by MRI. Because I say in an orthopedic clinic, you just want to image your wrist, you've got to stick the whole person inside the MRI system, which is ridiculous. And in a much smaller system, you can just stick your arm down it and image it that way. And by being closer to the wrist or knee or elbow or whatever, you can also potentially improve the quality of the image as well. So that's a key for us. And then similarly in veterinary medicine, if your dog walks into a vet with a limp, apart from the vet rubbing their hands, because they're going to charge about $4,000 for a cruciate ligament operation, if you want to get an MRI scan, they'll have to send you probably 50 miles away, and they'll be using an adapted human system, not a specific system. So we see an opportunity for veterinary medicine there as well, and potentially to combine with other imaging types is another idea we have, so that we can create a multimodal, it's called in the lingo, a multimode type of image. If you, for example, imagine fusing MRI and X-ray or MRI and ultrasound or whatever, you get different information from the different types of scan. And potentially, if we can go down that path, that would be really interesting as well.
And what's the sort of commercialization timeline? Because I know you've been doing a lot of R&D and you've got sort of like some good sort of development. Putting it all together and getting it to market, what are the sort of the key next steps?
Well, the very important next step is this year to get a system which has entirely got our components in it rather than some key third-party components. Yeah. And we're on track to do that this year, calendar year, I mean. Maybe, well, certainly the financial year, probably even in the calendar year. And then next calendar year, we'll be looking at having systems for testing, because we have to do clinical testing on the systems before they can be used in anger on people, or less so on animals, but on people. And so that's a very important phase next year of doing that clinical testing. And then once that's done, and once we've done all the further paperwork, and there's a lot of it, by the way, particularly in the medical side as opposed to veterinary, then potentially we have a system that's launchable in 2023. So that's what we're after timeline-wise.
Right. And then Stephen, just turning now to the spare land opportunity down in up in Luton. What's the sort of timeline on that one? Because I did notice in the results that it being pushed to the right because of COVID.
I certainly think there's been a COVID impact there, Paul. I mean, yes, it wasn't perfect timing, this disaster pandemic, but we still think there's
pandemic obviously to be perfect timing, do they?
Yeah, nothing's ever perfect. That's right. But we still think there's a good opportunity there. Just things are taking a little bit longer to get to fruition. People are still converting themselves to be working out the office and having those Zoom meetings. Over the summer, we find a lot of these contractors seem to disappear for a couple of weeks. Maybe it's to the south of France. It's certainly not where we are, because we've got our year end. But yeah, I mean, it's moving along. Just things are taking just a little bit longer. We certainly hope to be in a good position to announce something in this financial year, so FY22.
Okay, how big is the actual site, the land? Because it's 1,000 residential properties, isn't it?
Yeah, I mean, it's obviously that's apartments rather than houses.
Oh, okay, sorry.
So it's multi-story, but it's about 7 acres, Paul.
Yeah. Right. Okay. Well, that gives people a good thought about what it might go for, anyway. So, and then Steve, just in terms of current trading, obviously we finished the year end at the end of May. How's the sort of the first quarter been shaping up?
It's been a pretty reasonable quarter, as you'd expect, with the long-term contracts that we announced last year. I mean, order book at present's about 84%, circa the 85% this time last year. So holding up. And for FY 23, I would say it's about 40%, just over 40%, which again was very similar to the prior year. I mean, you'd probably say PSRE, because of its long-term contracting position with booths and Sellafield, is in a slightly stronger position than EPM, but EPM's got some good orders. And when, for example, the US nuclear chain really does open up, it's in a really strong position. So we're pleased where we are, but we're not, we've still got to be a little bit cautious, just because we don't know. Who would thought a week ago would all be running around trying to find petrol? Yeah,
well, I mean, given you're in the hotspots of renewables and nuclear, then I think your customers are going to be even busier if we start running out of natural gas, LNG, and also oil and gas, petrol anyway. But we've got plenty of oil. I think it's not a problem. So Steve, I understand there's plenty of money in the bank now. There's 23 million pounds, and there's some money hopefully that Stephen's going to get over this year from the land sale. What are you planning to do? How do you redeploy? I mean, you talked about the pie. Which areas and which regions will you be looking at?
Paul, I wish you hadn't gone public with the fact I've got 23 million in the bank. These guys will be coming looking for it. No, it's
there's envelopes at his house, Paul.
Go on. If this one's a Steve McQuillan question, sort of like, wait, what areas?
We'll both answer it, but I mean, I think that there's dividend, obviously, which Steve can talk about more in a minute. There's what we want to invest, in particular in Magnetica, which again I'll leave Steve to talk about. But I'll let me just answer the M&A piece, which is, I think, also sitting there in your thoughts.
Yeah.
Clearly, it's not burning a hole in our pocket. I mean, we only are interested in investing in a target asset if we can see how to at least double the investor's money. There's no point in doing otherwise. We're not in the business of huddling for warmth or getting bigger for the sake of it. So we're quite picky in that sense, Paul. We look at a lot of possibles. And we drop most of them because, for whatever reason, they don't fit our attributes or our market interests or our ability to grow the business and make it more valuable. So we're quite picky about it. But, having said that, I'd be amazed if in the next 12, 18 months we haven't made one or two more acquisitions. It's pretty likely we will do. What I can't say is for sure is which one or ones of those that we might stir the pot on or are stirring the pot on come through the pipe, or indeed any of them, because clearly you can also go through little barren patches where you don't find a target and then just wait until you get the right target. So, but with the state of the market and the way it is at the moment, as I say, I'll be amazed if we don't make one or two acquisitions in the next 12, 18 months. In terms of sectors, well, geographically it can be anywhere, basically. Although, in principle, we're in UK, US, China, India at the moment with Magnetica in Australia. So those four big poles are still interesting to us. And in terms of sector, it's, again, highly regulated markets we like. So it's nuclear, it's other parts of the energy space, it's medical. We were in aerospace before, we're interested in that. Defence is interesting to us. So anywhere it's highly regulated like that, we like those market sectors. So that's where we keep looking. And on the other hand, we won't ever go into places like automotive. That's not our thing, because we don't know enough about that type of supply chain. And typically when a business is in trouble in that sort of supply chain, it gets squashed by its customers before it has a chance to recover. So we don't like those sorts of sectors for that reason.
Okay. So then Stephen, on the organic investments, sort of like with Magnetica and other areas in the existing businesses?
Yeah, sure. I mean, it's a lovely position to be in, Paul, isn't it? When you sold PB for economic value of 35 million and 4 times your money, it leaves you in a strong position. But it allows you to have those choices, but it's not just picking up that shiny bauble, as Steve was just saying. But there is quite a lot of organic growth for this year. I mean, we've reinstated the dividend at 4 pence, as you're fully aware. And then next year we'll be looking to probably continue that with our interim and the final, and get back onto this progressively increasing it over the period of time. Dividend covers 4 times, even if you just use non-adjusted profit after tax. So, we've got the cash to do it. But a lot of investors will say, well, why don't you use that cash to invest in businesses and get bigger quicker? So, I mean, medical is one of the big investments this year. As you know, we were committed as part of the agreement back in January to invest another further 2 million to get ourselves to that fully developed Avingtrans component product. But the commercialization phase that Steve was talking about earlier, and the approvals, well, they're a bit eye-watering, some of the costs, for me anyway. And remember, I'm 51% Scottish, so it really does burn a hole in.
He's more Scottish than I am, Paul, as I keep telling you.
Allegedly. But no, so we have at the moment in the forecasts included all that commitment, which could be up to maybe another 6 million. Yeah, but that's pretty conservative. But we have possibly mentioned in the past that once we get into the commercialization phase or the approval phase, there are probably other specialists we'd like to bring in, and it's a very specialized sector, so we can really drive that on. So it may be a co-investment. We may do it all ourselves and keep all the rewards for ourselves, but there may be a co-investment to get us there to that final position later on. And of course, you know, what is that final position? Well, I'm sure you can smoke the joint like the rest of us. I shouldn't be encouraging that.
I would just point investors, actually, even though the shares have done quite well since we last spoke, they're probably about sort of 15–20%. But given your better than expected numbers, I've actually lifted the bar. I've increased my fair value, my sum of the parts, from 507p to 526p this morning, and that's still on conservative numbers of only sort of like 13 times EBIT for your two main divisions, compared to the market on actually 18 times. And on the current share price at £4.40, you're less than 12 times forward EBIT. So you've got plenty of ammunition. Well, there's plenty of upside there for investors, so it's good. So just to find, just concluding the news flow going forward, then Steve, how do you see M&A contracts, usual sort of business as usual sort of stuff?
Yeah. I mean, M&A obviously we can't time. It just happens or it doesn't. So it's very difficult to comment on that. Although, as I say, I'd be amazed if we don't do some acquisition or another in the next 12–18 months. Contracts, certainly we're working on a number of larger contracts, and we won't win all of those, but we'll certainly win some of them. So there should be some contract news again in the current year. And then if there's any other news that's appropriate, obviously we'll get it out there. There's other pieces of news flow, like the apprentice school at Chatteris, which was a nice story recently. So but we only like to comment when it's a really significant piece of news. There's no point commenting every time you win a £500,000 contract or whatever. We don't do that. We only comment when it's either strategically significant or when it's big enough to, push us to do an RNS. So we're not the best news flow business in the world, but hopefully when we do say something, it's because it's important.
Yeah. The other thing, actually, if you do get it, is if you reach a big sort of technical milestone on the Magnetica, that would be, the prototype works in, I don't know, clinical trials or something like that would be fabulous.
Yeah, clearly that's the sort of point we would put out news to say that that's a point we've reached, but still a few months away from that.
Okay, well, brilliant. Well, thanks very much, gents, and look forward to hearing how things develop. And if any investor wants to actually follow Avingtrans, just hit the button on the website. You'll get all the news flow and commentary straight into your email. So big congrats, gents. You've whet my appetite, and keep up the great work.
Great.
Thanks, Paul.
Thanks, Paul.